All right, you guys, we are recording. So I say this at the beginning of every single webinar is watch this again. It doesn't necessarily have to be the long strangle for this particular course on the roadmap to trading options, but watch another long strangle or this one again, because if you're newer to option trading or you're newer to the way that I teach, I'm going to go into some details or the nuances of some of these options that I don't think you're going to find elsewhere. So the first time through, it could go right past you. You might be thinking of a question or something like that and miss something. So if you watch it again, you'll catch some of those nuances, and it will actually make it stick into your long-term memory if you watch it relatively soon afterwards. If you wait a month down the road, it's going to kind of be like learning it all over again. All right, so without further ado, this is on the long strangle. Let me get a couple things out of the way real quick. My name's Eric Wilkinson. You may very well recognize me from mainstream media, where I've talked about everything from economic to geopolitical, and on top of that, how that impacts the market analysis. And I do daily market commentaries now as well, where I actually layer on top of it all these option strategies that I'm doing on a daily basis. It's up to you to know your risk parameters and implement those into your own portfolio in your own way. But what we're trying to do here is give you guidelines to follow along in order to implement the right option strategy for any given assumption we come up with. I talk about my assumptions based on the economic, geopolitical, and my market analysis in those daily market commentaries, so you can check those out as well. So I've traded in just about all markets and about all market conditions. I've traded everything from stocks, financial futures, commodity futures, currencies, and options on all these products in just about all market conditions. I don't ever shy away. No, I don't ever shy away from any market condition. Anyway, you can also follow me on Twitter at Wolfman's blog for hopefully some market wisdom and some snark. And as a matter of fact, if you're watching those daily market commentaries, you guys, for instance, if I cover a trade late in the day or pick up a trade late in the day, I'll kind of tweet that out so you guys can follow along there. Also, you can follow our parent company at Pro Trader Strat. And Facebook, you guys. Facebook is great right now because we're pushing out all kinds of content there at protraderstrategies.com. So please like us on Facebook so you can get immediate access to those. And you can see those daily market commentaries there too. I don't think we push out all of them every single day, but you get a lot of them so you can get the gist. All right, so this is, like I mentioned, the long strangle. One thing I want to do is take this, set it on the shelf for a minute. We're going to forget about the fact that we're going to do the long strangle, because on any given day, we look at the economic data, the geopolitical environment, we look at TV and find out, hey, you know what? This stock looks really good, or we're looking at the technical analysis. We're looking at those things to come up with our market assumptions. Well, we don't always go into it with, hey, I'm going to put on a long strangle today, so I got to find a underlying that I can do this with. No, it's really, we find an underlying, we've come up with an assumption, or we need to do something in our portfolio. And I talk about this a lot in those daily market commentaries, you guys, is adding positive deltas, which means get long in a portfolio, or more importantly, for a lot of us, we have a portfolio that is very long. So we are beholden to a market that goes up. So a way to add some protection is add negative deltas, or something like this with the long strangle, because right now we're at a fluctuation point, and this is particularly important right now. Are we going to go up or go down in the markets from here? So we can look at it from a broader index or future ETF, something like that, correlated to maybe the SPY, the QQQs, or the Dow Jones or the DIA. We could also look at specific underlyings that we think are going to break out, but we just don't know. Maybe it's one of these drug stocks right now that are really top of mind. If they come up with a vaccine, they're going to blast through the roof. But if they have a failed vaccine or something like that, like AstraZeneca, they could fall out of bed, right? They're either going to do really well or they're going to fall on their face. Well, that could be the right time to implement a long strangle. But right now, let's set that aside and talk about our roadmap key, all right? Because we are doing the roadmap to trading options. Well, we need to know what the key is. And yes, I hope you guys aren't just flying off the shelf right now like your heads are exploding. No, he's not talking about the Greeks. Yes, I'm going to talk about the Greeks real quickly. But what I want you guys to, I'm going to try and make it real easy for you guys to understand what these Greeks are so that, you know, I can streamline your process when you're thinking about this, because they are really important to options trading. So these are really important. One thing to think about with Delta is it's just data. And I'm not going to go over all of the things that Delta tells us, but one of the important things that we can talk about here really quickly is its effect on the options premium in relation to the underlying. So what Delta tells us is we're always assuming with the Greeks that we're moving forward, or it's moving higher in a sense. That's the one given assumption you need to kind of know with the Greeks is it's expected a dollar move higher, volatility goes higher, a day goes by, right? So Delta tells us the effect on the options premium. So let's just take a look at right now an options premium here. So when we're looking at, let's just cherry pick these 150 calls here in Johnson & Johnson. So what we're assuming is that Johnson & Johnson increases by $1, right? So now we're at 149.35. Okay, so that's a $1 move higher. We can all agree on that, right? So what we see is this delta is positive. We've got a positive delta, and that 45 cents will add into these premiums. So if we look at this, now we're going to be looking at $4.05 on the bid. If we moved a dollar higher, all other things move, or you know, we didn't have a day go by or even a second go by. So now these 150 calls would be $4.05, because remember 45 cents is adding into that. And then these the offer is going to basically be $4.20. Okay, so that's a dollar increase. Now if we look over here at the corresponding puts, we can see that I'm just going to look at the 145 ones now just to kind of make things easier. These would decrease. You can see there's a negative delta there. So if the market moves higher by $1, that first dollar move higher, these 145 puts would then decrease by the corresponding delta. So we would be looking at $2 and they would go down to $2.62 on the bid, and these would be $2.72 on the offer. Okay, so they would decrease by that corresponding delta. Pretty simple so far. Vice versa, if it went down by $1, right? Think about it this way: if we went down by $1, well, a negative dollar plus a positive delta would make those calls a negative delta, so that premium would have decreased by the corresponding delta. And on the other side, the flip side here, we've got a negative delta. And if we move down by $1, a negative plus a positive makes that a positive. So if the market moved down, obviously, then the delta would add into those premiums there. Now, when we're talking about gamma, this simply put is gamma goes with delta. All right, gamma goes with delta is the easiest way to remember that. So when we're talking about here, we said we were talking about $1 move higher. Well, now we're talking about the second dollar move. All right, so this is on, think about it as dollar number 2 when gamma starts adding into delta. Yes, gamma will, if it goes up by 50 cents, $1.50, right? Well, then half of that gamma is adding into that trade as well. So if we flip back here to where we were talking before, now we're at 150.35, so an exact $2 move, just to keep math easy, right? So we've increased by $2 here. So now this gamma is 3 cents. It goes with delta on the second dollar move. So the second dollar move higher, our premiums are increasing by 48 cents. All right, so now we would be looking at $4.53, right, on the bid, and the offer is going to be $4.68 on that second dollar move. Now look over here, the gamma on this column in the put side is positive, right? So if we moved higher by $1, the second dollar move, gamma goes with delta. Well, you've got a negative 38 delta plus a positive 3-cent gamma. So now that second dollar move higher, these premiums are only going to decrease by 35 cents, right? So if it decreases by 35 cents, we're going to be looking at $2.27, right? $2.27 on the bid, and then decreasing by 35 cents on the offer, we would be looking at $2.37. But you guys can check my math on that. I think that's right. So, but you get the gist. That second dollar move, that premium is decreasing by 35 cents. And on the flip side, obviously, a negative dollar move, if we talked about a negative $2 move, then the next, if we moved away by $2, then our deltas are negative. So a negative delta plus a positive gamma, those would only decrease by 42 cents on the second dollar move, right? On a downward move. So you can kind of keep track of it that way. So gamma goes with delta, and we can keep track of that by our pluses and minus. A negative plus a positive is a negative, and things of that nature. Now, when we're talking about theta, we always say on the floor, theta was the thief in the night. It's the thief in the night that comes and steals your premium. Now, with theta, theta is going to affect our premiums every single day. Now, we can't go back in time, so we can see that theta is always negative. You can't really make theta a positive unless you sell that premium, right? If you're selling premium, then that negative actually helps you. The premiums are still going to go down due to theta, all else being equal. You know, the day is the only thing that changes. So like we didn't see a change in our premium. It's exactly penny for penny where we were yesterday. Well, we would see that tomorrow opening up, all of our premiums would decrease by that corresponding theta. So you can't make theta a positive unless you're selling the premium, and then that's actually a positive to your P&L because, right, those premiums are going to go down, so it helps you. So you can use theta to your favor, like open up the doors to allow theta in. And, you know, one thing to note with theta is it gets more and more aggressive the closer to expiration. Like the theta inside of this 8 days could be twice as much as what we're seeing here at 36 days. And, you know, if you looked out at like 70 days or something like that, it is less aggressive the further out on the expiration cycles. So further days to expiration, theta isn't as aggressive. So if you're buying premium, and, you know, we are kind of thinking about buying premium with this one. So, you know, get those levers and pulleys kind of going, the cogs spinning in your head. You know, you want to, if you're doing a long strategy, you need to get further out in time in order to limit that thief in the night that comes and steals those premiums. Vice versa, we just got through a bunch of option strategies where we were selling premium. We wanted to take advantage of it. So, you know, this was kind of that wheelhouse we were talking about. Well, now we're leaning towards something else, and we don't want this thief. We want to at least limit it, maybe lock the doors, and the only way to do that is to get further away, which is what we're going to try to do. So you can see that theta is always a negative. Just remember, the closer to expiration you get, that thief gets really, really aggressive and starts taking away those premiums. I'm going to talk about theta a little bit more here down the road. All right, so, and Vega is just volatility, all right? So we're talking about implied volatility specifically here. Now, implied volatility measures the change in our premium as well. So this is an increase, assuming an increase of 1%. So when we're looking at an assumption, now we're talking about leaving this, you know, the same. We're trying to isolate theta, and we're talking about this goes up by 1%, right? So we go up by 1% on the corresponding Vega. which is just implied volatility, and that's forward looking. And historical volatility is looking back in time. I like to look at forward looking just about everything, even data points. So in that regard, it's forward looking, so that's a key metric. So if it goes to 27.57, right? So that's an increase of 1%. Then what we would see is our volatility is, or Vega is positive on both sides. So an increase of 1%, we would then see our premiums here on these same 150 calls go to $3.79, right, on the bid, and then they would increase here on the offer to $3.94 on the offer. The flip side, even on the calls, or sorry, on the puts, we increase by 1 percentage point. That's still a Vega that is positive. So we would be looking at $3.18 on the bid. And then on the offer, we would be looking at $3.28 for a 1 percentage point increase. Now, you guys might be like, okay, that's not a whole lot of money increase or decrease. We've got Delta that is a bigger factor in size. Well, usually when we see volatility moving, it's moving at, especially recently, is moving at clips of more than 1 or 2%. So extremely important to understand and know where volatility is, because that's what's going to affect our premiums. Now, volatility also affects further duration options more than the nearer duration options, right? So again, get those levers and pulleys going. If you want to exploit expanding volatility, probably, and limit that theta decay, you want to get further out, all right? If you want to exploit theta and get that volatility contraction, the idea is to come closer to the expiration cycle and get the nearer term. So if you're buying, you want to kind of get further out in duration and you want low volatility. Now, something to note here, like 27, 26, what does that mean? It means absolutely nothing, really, other than we need to know what that number is for Johnson & Johnson. All right, so I'm not talking about the VIX. I'm not talking about, looking at 26 in relation to Tesla, because Tesla is never going to get down to 26, all right? Tesla is a tech stock. The staples usually have lower volatility than, say, the tech stocks. So maybe even Apple doesn't get down to 26 anymore. So what we need to do is, if we are looking at Johnson & Johnson for a breakout or a sell-off for whatever reason, then we need to specifically know what that number 2657 means. We need to know where, if that's high or low for Johnson & Johnson, because if it's high, that means those premiums are the most expensive you've seen, and say, the last several weeks. And when it's extremely low, say at the bottom of the barrel, well, then those premiums are super cheap, all right? So if we're thinking about strategies, option strategies, well, we need to know where that is, because we want to buy low and sell high. I mean, just like a stock, you want to buy a low, sell it high. Well, same thing with options premiums. We want to buy them when they're cheap and sell them when they're expensive. And the only way to determine whether they're cheap or expensive is to look at implied volatility for that specific underlying. And then we can determine if it's at the higher end of the range or the lower end of the range. And I'm going to dig into that a little bit further, but I want to get our roadmap key out of the way. So that's pretty simple. I mean, you guys following along with me so far on the Greeks? I mean, hopefully nobody's brains are on the wall, like they didn't blow anybody's heads up on trying to dig into this. I think that's pretty simple. Theta is the thief in the night that comes and steals your premium, and he is aggressive right before the expiration is over with. I mean, he's trying to take every single penny he can. He doesn't want to get caught when it's a long time away. He's more concerned about those ones that are going off the board, and he's got to take every penny he can. Gamma goes with delta. Delta is data. It not only tells us, some of the data that delta tells us is, how it affects our premiums, but it also tells us the probability of being in the money. So for instance, a 45 delta that we talked about for these calls, that means that at expiration on October the 16th, at expiration, there's a 45% chance that Johnson & Johnson is going to be trading. There's a 45% chance that Johnson is going to be trading 150.01. All right. And flip side, that's a 7% chance that those corresponding calls, it's a 7% chance that it's going to be at 165.01. Same on the put side. We're looking at a delta here. It's a 6% chance that it's going to be trading. There's a 6% chance that Johnson & Johnson is going to be trading at 124.99. So 1 penny in the money. All right. So delta also, that's one of the reasons why delta is considered data. Or I like to consider delta data because it tells us all kinds of interesting things. Gamma goes with delta. Theta is the thief in the night, and volatility is probably, it's the one that's not a Greek, but it is the most important Greek. All right, so now we're on a road trip. We're doing our roadmap to trading options. Where are we going? I already looked at Johnson & Johnson, so you can say we're at Chicago. Well, one of the things with this strategy is, I'm trying to think, Johnson & Johnson, I'm just trying to figure out where I want to go. I'm going on a road trip in this one, and, we might not necessarily know exactly where we're going. We are kind of, thinking, all right, well, we could go this way. I'm planning this way out in advance, but I want to see what the weather's like before I really decide where I'm going to go. So I'm either going to go, if it's really cold or snowy going up this way to Washington, then I'm going to probably go down to Phoenix or something like that. If I see that there's snow in Montana, I might actually go to Big Sky or something like that. All right. So the idea is we're open. We just don't think, we know we're not staying here. We're going to either go north or we're going to go south. But one thing we know for certain is, just kind of trying to correlate this, is we're either going to go there or we're going to go there. We know, we just don't believe we're going to stay at home. We're going somewhere for spring break, and we're trying to plan that trip right now. But we're going to kind of leave it open because we've got a lot of flexibility, all right? But one thing we do have to figure out are those destinations we're looking for good destinations, Is Washington a good destination? I'd probably think I'm heading up to Canada. I love Whistler, so if I'm thinking I'm going to go skiing, I'm going to go there. And, if there's no snow up there and it's a crummy spring break or it's a La Nina, I think La Nina is the one where there's not a whole lot of snow, right? Then I'm gonna head for some summertime weather, or maybe even head out to there. So at the end of the day, haven't really decided exactly where I'm going, but definitely not staying in Chi-Town for spring break. We're heading out of town. So how do we determine whether those are good places to go? Spokane, Washington, I don't even know if there's a ski resort there that I'd want to go to in the wintertime. But what we want to do here is we're going to be looking at whether or not the underlying we're looking at. So I'm obviously kind of picking on Johnson & Johnson because I believe it's either going to break out or it's going to free fall. And I'm also going to be looking at the ETF for the Dow Jones, the DIA, because, with today's market action or this past couple of weeks market action, it feels like we're either going to spike or we're going to drop down, right? And it doesn't feel like we're necessarily going to stay right where we are for foreseeable future. So that's another one I'm looking at as well. But I wanted to look at a specific for a stock to make sure we follow this rule for a good destination. So when I'm talking about a good destination, what I mean is this underlying that we're looking at have good optionality? Does it have good options? All right. Do a lot of people trade this? Are a lot of people going there? Kind of think about your destination. Is there a lot going on where we want to go? I mean, I don't want to go to a one-horse town, or that a town where you blink and you didn't even realize you drove through a town. I want to go to somewhere where there's a lot of eyeballs, a lot of people, a lot of things to do. Well, when there's a lot of things to do, that means there's usually a lot of eyeballs in and around that place. Well, how we can determine if there's a lot of eyeballs in the option montage, or the option montage is this page here, is we can look at a stock. So any stock that is greater than $100, all right, then we are going to move the decimal 3 ticks to the left. So in this case, we're going to go 1, 2, 3, and we're at basically 14.8 cents, right? We can round that up to 15 cents. Just call it 15. All right. So what we want to do is look at 15 cents, come down here to the option montage, and you're going to look at the spot month. This is the one where most people are trading, if they are trading this particular underlying, okay, in options. And don't just correlate this volume up here to having a lot of people trading options, because we can see stocks out there like Aon doesn't always fit this rule, but they don't have a whole lot of trading on any given day in the options. You can flip it over here and look at the volume and open interest. I have no problem with that. If you see a lot of volume and open interest in there, that's pretty good indication that there's a lot of eyeballs in there. But, I like to streamline the process so that, or have little triggers that are easily remembered, kind of like, your Theta and the thief. Theta's the thief. So we look down here, we got 15 cents. We can see the calls fit that rule, and we're looking at the ones that are just slightly in the money or slightly out of the money, all right, to fit this rule. And we can see that Johnson & Johnson pretty solidly fits that rule. So what I would say for this is when we're talking about doing something in regards to the road mapping, right? So we could say that we're looking at a stoplight here. Okay, so if it fits my rule, so for instance, this one's 15 cents, that's a green light. So we could say, all right, right now it's a green light. If you see it going 2 times the rule for the destination, that's a yellow light. And 3 times the rule, I would say, is a definite red light. Obviously, yellow light, proceed with caution. You get too many yellow lights, it's probably not the underlying or option strategy we want to be messing around with for that particular underlying. But one of the first things we need to know right away is, all right, you're going through your or you're going through your charts or wherever you've heard, maybe you heard something on TV. The first thing you do is go over there and look at your charts. You come up with a market assumption. Now you kind of need to know if you want to get involved in these options, all right, trading options around that market assumption. And why? Because if the market is really wide, you can imagine for Johnson & Johnson, $150 stock, if it was, 50 cents wide, well, that means there might be only one person in there trading that underlying, and you're going to have to give up a lot of edge to get in and a lot of edge to get out, and that could really hinder your profitability. If you had to give up 30 cents to get in and 30 cents to get out because those bid offers are like 65, 75 cents wide and only one person's in there trading, well, that means you got a lot of making up to do with either Delta or the Theta. You could see, 6 cents a day, that could take you 10 days just to get to even. If you had to give up 60 cents to get in and 60 cents to get out, well, you hit the bid to get in and now you're lifting the offer to get out. Well, if nothing else changed and all this market did was trade sideways, you can see that you took a lot of risk in that trade for absolutely no reward. So that's another thing here, is we want to make sure there's a lot of traders getting involved here. So the right destination, we're looking at move on a stock that's greater than $100. We move the decimal 3 ticks to the left, and that's good for, you know, like a Tesla or Google and stuff like that. You can usually see that in these options that are closer to expiration, that it's gonna fit that rule. Now, if it is a stock that is less than $100, so if our stock is less than $100, then basically we need it to be less than or equal to 10 cents wide, and that would be your green light. 2 times the rule, obviously a yellow light, and 3 times the rule, we're looking at, walking away. And obviously you get below $50 stocks, you're going to want to see those bid offers get a little bit tighter as well as you're following through there. All right, so there we go. What is the environment around Johnson & Johnson right now? Now, when I'm talking about environment, I'm talking about that Vega. All right. Now, where is Vega? Sorry, Vega. Where is Vega in and around that underlying? Now, we can kind of think of it as low volatility, kind of implies it's sunny roads. It means that basically there's no inclemental weather. You're not going to be stressed out. Think about low volatility is, sunny roads because there's low stress when you're driving, but when it's snowy or inclemental weather, then, you have a little bit more stress. So the market, you want to get there a little bit more quickly. You're not going to have as much wiggle room in order to get there. You're not going to want to get out, walk around, smell the roses. You want to kind of beeline to your destination and get out off the road, right? Or maybe it's a rough road or something. So when we're talking about this, we're talking about that implied volatility number, right? That Vega. So what we need to know is, where is Vega? Gosh, can I spell today? So implied volatility is what we're looking at, and implied volatility is Vega. All right. So what we do is we say, where is the current, which is that number in the option montage, current IV, all right, minus the low IV. We take that sum and divide it by the high IV minus the low IV. Sum, all right. All right, so then that equals implied volatility percent, all right, is what we called it on the floor. And Thinkorswim still uses that today. So what that current IV is what we're looking at in that option montage. That's the current. We need to look at a chart in order to really discern where that implied volatility percent is. We need to look at a chart to figure out, because we need to know where the 52-week low is. You can think about this as the 52-week low and the 52-week high, right? It's kind of like a regular chart. We look at the charts to see where there's support and resistances. Well, believe it or not, volatility for that underlying has support and resistances that it experiences around volatility as well. It has a tendency to want to stay within a certain range. Like volatility will kind of do this, but implied volatility, if this is IV and we were looking at Johnson & Johnson, well, we can see on a chart a lot of times that it's kind of in a range. So we want to look at those ranges to determine and this could be like 70 or something like this, and this could be 15, right? So it usually will not go much below 15 and not go much above 70. So we can see that when it's down around this area, down here, then we can see that premiums for that underlying would be relatively cheap. I mean, can we agree on that? Because everything else is equal, right? We're going to see that underlying experiences the theta, and yeah, it's a little bit less further out in time, but one of the major determining factors at any given time determining what those options premiums are is the volatility. All right. So volatility is one of the most impactful things in and around those options premiums. So why does volatility matter? Because if we are seeing low volatility and it goes higher, well, we would expect that those premiums are going to increase, right? If volatility goes higher, those premiums are increasing. So, obviously you would want to buy when those premiums are cheap. And if those premiums are already up or volatility is already really high, up there at around 70, and let's just say this is at around 15, right? Well, if the volatility is up here, well, then we would be expecting that volatility to drop. And we see that show up in the charts as well. But, obviously, if volatility is high, we're going to want to sell premium. That means you want to sell options premium. We talked about that a lot in the last couple of webinars where we were selling premium. And when volatility is low, we want to be buying premium or getting long options premium, right? Or long strategies, buying calls, buying puts, depending on our directional assumption. And when we see it extremely high, we want to be selling it. Now, this is a blow up of that Johnson & Johnson trade right now. And, if this is taken into effect right here, and those are those March highs that we saw when coronavirus was exploding. But keep in mind, I believe that those highs, and I've talked about this in the daily market commentaries quite a bit. Yes, it is possible. Don't get me wrong. But the last time we saw some kind of spike like this, that high across the board everywhere, and we experienced that everywhere, I'm not going to lie. But the last time it really spiked that high was when? Does anybody know? It wasn't even in 2008, 2009. It was all the way back in 1987. All right. So, that's a long time coming. So we on the floor and probably have heard on TV, maybe even you guys do it also. We call that a black swan event. All right. It's a very rare occurrence. All right. So if you believe, though, I don't want to dig into your head, and because I might very well be wrong. Maybe we could, all of a sudden there's a news story out there that cannibal ants have broken out of a bunker in Russia. They thought they had them contained. Well, I mean, maybe that's the new thing. We had the killer hornets. Now it's cannibal ants. Well, I don't know. Is that going to spike it? Who knows? But it could. I don't believe, though, probably in the next month or so, and especially probably even the next year, that we're probably going to see that. So I'm a little bit biased. But if you're looking at specifically, especially on Thinkorswim or, usually your platforms, and they have this IV percent, it's taking this into account, all right? So like right now, it's saying IV percent is at like 16.23. When we take in this high of around 85, let's call it, this low is probably around 15, all right? So, and where 26 falls in there, it's basically saying the math is 16.23%. So what I want to do is I want to look at it where I've taken some of this black swan event out of the equation, all right? So I'm just going to kind of cherry pick, and I'm going to say, all right, maybe this, it did spike again here. We could probably get another spike. So I'm going to say 40 is that high, all right? And I do believe that we are experiencing high volatility because there is still a lot of unknown out there. And I don't think we're probably going to get back down to those lows, within the next couple of months, right? And that's usually what we're talking about with, trading strategies or getting involved in these. These are usually shorter term strategies. I'm not thinking necessarily for this one a long-term, 2-3 years out. So I want to kind of keep everything into perspective. So I'm going to say that 20 is that low. So we know the high, we're going to say the high is 40. All right. And this is implied volatility. All right. And the low, what did I say was 20? The low is 20. And we can see the current is 26.37, all right? So what I want to do is take the current IV minus the low IV, right? Take that sum and divide it by the high IV minus the low IV. All right, so we've got the current is 26, I'm just going to call it, minus 20. We're going to take that sum and divide it by the high, which is 40, right? Minus 20. So we basically have, all right, no questions so far. We've got 6 divided by 20, and that's basically, right around 30%, right? Or 30%. Okay, so it's in the 30 percentile-ish, right? So what is the rule here? The rule here is we've got a couple of rules that we're going to need to talk about. So let's pull up this red light, green light thing. All right, so I would say that a green light is, a definite green light. And then I'm going to kind of go to looking at, anybody's risk parameter or most people's risk parameters, even if you are a newer trader. I usually say for a stock, it's pretty cut and dry. IV percent below 50 on a stock, it's time to buy. If it's IV percent of above 50, that's the time to be selling premium, okay? So if you are newer to options trading, you may feel like you have a lower risk tolerance. I don't know what those are, but I have a relatively high risk tolerance. So I'm looking at it as you're below 50, it's going to want to migrate back up to the median. We can think of it as that as 50 is like the median. So you get below that. Doesn't mean it can't go below where I'm at, but I do believe, I feel that it's ready to start curling back up. And vice versa, when it gets to extreme levels, it gets a little overdone. People will start coming in and saying, these premiums are too expensive. I'm going to look to sell it. At least the savvy trader, I should say. All right. So, but if you have a lower risk tolerance, you could say that, greater than, I don't know why I want to write this. I want to say, all right. So greater than 75%, greater than 75% is a green light, or less than like 30% for a stock is a green light. So that would be your green light. If you are looking at being if you said greater than, actually, I don't want to do that. If it's, sorry, I was confusing myself there. So let's do this again, because I don't want to confuse you. I was getting a little long there, so let's start over. So we've got our things here. So, and we're thinking about buying premiums and stuff like that right now is what I was going to lean towards selling as well, but let's just get this out of the way first. So if you're thinking about buying premiums, you want to basically say a green light is less than 30%. And if it's between basically 50, you could say 50 and 30%, 50 to 30%, that's a yellow light. And if it's greater than 50%, get my greater than, less than, greater than 50%, that is a, I want to do this, make sure, less than 30% when you're buying. This is for the buy side. When you're buying, it would be that way. So less than 30% is a green light for buying. 50 to 30% you can think of, okay, that's about a yellow light. And greater than 50% for buying is a red light. And on the flip side, if you were looking at it for the sell side, and on a sell side, it would be just the opposite, right? So if you're thinking about the sell side, then greater than is a green light. So greater than, say, 75% or 80, 70%, you could even say greater than 70% is a green light. Then basically a yellow light is 70 to 50%. This is for the lower risk tolerance on that one. And then a red light would be less than 50%. Okay, so on the sell side there. So a little bit different, but right now, what we would be saying here is we're right at 30%. One could say that we are a little bit lower than that. Then we need to be thinking that we're buying, okay? So at that range, anything, what I usually say, anything below 50, you're considering buying. Anything above 50, you're considering selling. But if you want to, if you have a lower risk tolerance or newer to options trading, think anything above 75, I'm selling. Anything below, 25, 30, I'm buying. So we're right there fitting both of those. So we got to be thinking that we are buying, which is we've got low volatility. It's sunny skies. We are looking to buy. So now think about this. Back to the theta, right? Get back to those roadmap. What is our duration? Well, our duration is going to be longer term, right? Because we've got low volatility. We know our premiums are cheaper. We know that volatility is very low. Our premiums are the cheapest. We want to limit that theta decay when we're buying, right? We want to give ourselves enough time to be right or get to our destination. We want to limit that theta decay. So when we're buying options, a trader wants to limit that theta decay. And here's another representation of it, right? We want to kind of get out here in this area. You can see that the slope out in time, and these are the at the monies. We're going to be dealing with slightly out of the monies, but you can see that that theta gets really aggressive inside of 70 days, but inside of 35 days, your premiums drop by 50%. So we want to limit that theta decay. We want to limit that drop in our premiums by getting out here. All right. And hopefully if our premiums are dropping through theta decay, all right, and we get volatility and vol comes into the picture, vol starts going up. Well, what we can see is that volatility will start pushing this curve up a little bit. It's going to feel like that. All right, because the premiums are going to start, the option price is going to start going up. All right, so that's what we want to take advantage of. Volatility affects these premiums out here. We could start seeing those premiums go up. We could be directionally wrong. As a matter of fact, if you guys watched the BABA trade that I did for last week's webinar, you saw I was directionally wrong, but was able to make money on that trade because of volatility and how it was affecting those premiums. All right. So what vehicle are we going to use? We're going to use the long strangle because I still don't know where I'm going to go. I don't know if I'm going north or south, but I know I'm going somewhere and it's not here. All right. So I think there's and I feel this way right now with the way the market's acting, right? Especially, I started out when I was looking at this yesterday, I was thinking I was going to go with something like Johnson & Johnson, but after the way the markets are acting today, I'm thinking maybe more of an ETF, right? Because my portfolio is relatively neutral right now, but I want to take advantage of a big breakout to the upside or the downside, and this is the best way to do that. If there is a big move coming, I can take advantage of it. And just so we're on the same page, we can take a look at DIA. And even if I said that, right around in here, even if I said that this was one of those highs, where's my mark? This one. Even if I said that this was the range, the new range, this might be the low. I'm going to kind of ballpark it. and that might not necessarily be level. But you can see again, when we're talking about, when I was talking about where this is in relation to the highs and lows, but you know, we get a big sell-off, a massive sell-off. We're definitely likely to test that. You could even say maybe that's the high, I don't know. But you can see that this is definitely at the lower spectrum of implied volatility at 27 in relation to where it's been in the past, okay? So as we can see, you know, it's pretty low right now, pretty benign. And, you know, with a big breakout, that will allow us to see our premiums really expand as well. So as volatility expands, you know, that will help us. But also, if we get a big directional move in one way or the other, that's going to make this trade profitable. Another thing to think about with volatility that I forgot to mention, you guys, is when premiums are cheaper. All right, volatility also tells, you know, there's a mathematical equation. I'm not going to go into all of it right now, but even like the VIX will tell you what the expected daily range is. So as volatility gets bigger, that expected range is much greater. So if you think about this, when you're buying premiums, you're actually able to get relatively tight to where the underlying is because there's no expected range. At least the market's not expecting that. But then once that happens, that volatility expands, the expected range goes way out. Well, you know, again, those premiums jack up. And if you're buying it and that volatility expands, you know, your probabilities of going into the money are greater because delta is going to increase. Also, those premiums get jacked full of premium, and it will help us offset any misdirection we have. So we want to get involved in setting these strategies up at a time where we can be successful, you guys. That's one of the few things we can do when we're trading is set ourselves up for success at the very onset of trading. And this is how we do it. If we want to limit that theta decay and limit, you know, if we're buying premium, we want to limit that theta decay, we got to get further out in time. We also, if we're buying premium and we're further out in time, that volatility expansion will help us. And when we're selling premium, we want volatility to help us, or we want theta to help us and pick away from that. And we would be selling expensive premium. So when you get that volatility crush, like I got in that BABA trade, that helps us. So now in this one, I'm expecting one of us to either break out or start moving to the highs or sell off and go towards, you know, maybe the 200-day simple moving average, something like that. I mean, just pulling that out. But I'm expecting this market to really start juking here. So that's my thesis in this trade. Now, I'm not trying to talk you guys into this at all, okay? I'm just hypothetically speaking, you know, if we were looking at this chart or I heard something or whatever, however an assumption, however you come up with this assumption like I'm talking about, then that's would be the time for this. Like, I think this could, and we could be talking about the, like I said, the drug stocks, the drug makers, right? If they somebody comes out with a vaccination, boom, market is going to blow off the top. And if they fall on their face and all of a sudden their trial result comes out and it was killing people, well, oh my God, their stock is going to fall through the floor, right? So those would be big moves that you could expect to happen depending on the news. And right now, if you had volatility around that one of those drug stocks that was really low, and that was your assumption, that's the stock you would implement this around, as long as it fits all the other rules, right? But I'm just coming up with a directional move in DIA that I'm thinking I want to implement into my portfolio, which is specifically why I'm talking about it. I'm not trying to talk you guys into this. Don't want anybody to ever believe that that's what I'm trying to do here. All right, so we know we're doing the, let me get rid of that. We know we're doing the long strangle because I expect this big move blasting out in one direction or the other. So where are we going to go? Well, if you go online You know, I know you can find out how to do the long strangle, right? What do they tell you? You buy, it's going to be in red. I'd want it in green, but you're going to buy an out of the money call and you're going to buy an out of the money put. There you go. That's pretty simple. Well, I'd like to take it a little bit further. I like to give you guys some locations here. So we're going to be buying, you know, I want to streamline your process so that we have higher probabilities of success here rather than just pulling out of the money calls and puts out of a hat. So we're looking at a 30-ish. All right. I'm saying 30-ish because not every single strike or every single underlying is going to have a 30 delta, but that's what we're leaning towards, that 30 delta, because, you know, a 30% probability of being in the money is relatively small, you might be saying, right? Yes, that is. But I'm not planning on being in this all the way to the last day of expiration. For one, I know I'm fighting an uphill battle once it gets inside of that, 35 days to expiration. So I kind of want to be out of this trade before all of that starts happening. I definitely don't want to deal with the last 7 days because that really eats up your premium. It all becomes what the value of those underlying or the strikes are. But another thing, a little floor trader hack here for you is delta, right? Tells us the probability of being in the money. That's what we're talking about here. 30% or out of the money call is going to have a 30% probability. Out of the money put is going to be a 30% probability. But 2 times delta equals a probability of getting kissed. Probability of being kissed. I don't know. Is what we used to say on the floor. That means the market comes up and kisses your strike, or the market sells off and kisses your strike. That's all I'm looking for here, is to get this market that's going like this to break out and hit one of my strikes, or like that and hit my strike, okay? Because I know the probabilities are that it's going to kind of do that afterwards. And this is not what I want to happen, right? I don't want it to start trailing back away from my strikes. So 2 times the probability of getting kissed means I've got it then within the duration of 60% probability of it hitting, and this is a hack. It's not necessarily given that it's going to happen, but know that this is pretty solid, especially for the longer durations, right? So a 30% probability of that happening. Now, if volatility starts going up, your probabilities of that happening are even greater than what we're talking about here. But that's why we're looking at the 30-ish delta call and the 30-ish delta put. All right, buy it. All right, so direction, we don't really know. We just know it's going to either break out to the upside or, you know, blow out to the downside. Our destination is, you know, the our rule of move the decimal 3 ticks, 1, 2, 3, or, you know, if it's less than $100, it's got to be, you know, less than or equal to 10 cents. Okay, so you move the decimal or less than or equal to 10 cents. The environment, we want low implied volatility. And there, we're going to be looking to less than 50%, which is what we got, all right? Because we got ours is equal to 30. All right, our destination means that there's a lot of open interest, right? So we're looking at open interest. All right. Oh, our duration. I was thinking destination there. Our duration is going to be, if we have low environment, right? We have low implied volatility. Our duration is going to be somewhere around 70 days to expiration is what I like to look at. All right. So right around there, you know, I would always lean towards going further away than nearer, because remember, the closer you get, the faster the expirations or those theta starts picking up. And our strikes, we're looking at the 30-ish delta call and put. Just as a bit of a refresher here, all right? So keep that in mind. Now, because we're buying, our max profit is unlimited. This is an unlimited profitability to the upside. Obviously, if it goes down, there is limited to zero, right? We're not staying into it. It's going to feel unlimited in either direction. You guys are going to be hooting and hollering if it goes even close to zero. Even if you got a 20% correction, you guys are going to be going crazy. Those puts would be well in the money at that point. All right, so max loss is the premium paid. So we know we have unlimited reward and limited risk, because when you pay a debit, you have a limited risk from the debit you paid. All right, so whatever your premium is, that's your max loss. Now we have two break evens. And the reason why we have two break evens is because we have a call and a put, right? We're buying a call out of the money at 30 delta, and we're buying a put at a 30 delta that's out of the money. Now, the market can't go in both directions at once. It could go up and hit both of them during the duration, yes. But this is all at the assumption that this is expiration, like there's no days left, all right? So if there were no days left in this expiration cycle, then our break even would be where the underlying price is equal to where that long call is plus the premium, right? So you take your premium and add it to the long call. You know that's where your break even is at expiration, all right? On the flip side, it's your long put minus your premium is your break even at expiration. Now, that doesn't mean to get to profitability, it has to go to the long call plus the premium in order to make profit here. No, if it starts happening right away, or even if volatility starts expanding, then, you know, that helps us immediately, all right, be profitable. So it doesn't always have to go up there and hit that long call strike, you know, plus the premium in order to be profitable. That's where you need to be at a break even at expiration. Everything else kind of expires worthless. So now let's get into a real life example really quick to take, oh wait, one other thing real quick. So on a winner, I look for it to hit my strike, one of the strikes. For a winner, it needs to hit the strike. Hit my strikes. All right. All right. And I'm gonna switch it up and look at DIA. All right. I'm gonna look at DIA and I'm gonna find what road we're taking here on the strikes. So let's take a look at that real quick. So let's pull up a options platform here. Pull this up over here. All right, so I'm looking at DIA. I think the volatility is relatively low. I think we're ready for a breakout that could that would help me with the expansion there. I have no trades on in DIA. So am I going to use these? One thing I got to do is look at this. It's $250. So move the decimal 3 ticks. So we should see that these options, 36 days to expiration, fit that during open market operations. Now, everything's canceled after the market today. So, but you can see there's pretty good volume and open interest across the board in DIA. So I'm going with it. I want to go out to around those 70 days. That's what I said was the sweet spot. So that's where I'm going to kind of look at. And now I need to know where my deltas are. So I'm going to be looking at around the 30-ish delta. So my strike location is going to be the 292 and the 30 delta down here, 259. So when we were talking, so we're paying a debit of $12.75. I'm obviously, you know, depending on your portfolio value, I only really want to allocate, 10% or less to this trade versus my portfolio value. Okay, that's another thing to keep in mind. So don't ever go all in on any assumption. I don't care how smart you think you are. Stay away from that. So my break even to the upside, you can see, is at 300 and what is that, $4 or so, 305. That would be at expiration though. But my probability of the market going up and hitting my call or put is about 60%. That's within the next 70 days. All right. You can already see at the end of all of this, it's only expecting a $29 move from where we are. Well, that would basically, that could easily be where my two strikes are going into the money, right? So implied volatility gives us the expected range here of $30. So we can see that my puts and my calls would easily be in the money at expiration, could easily happen. And there's a darn good probability that it will work. If you're looking at the charts here and looking at, all right, it coming up and testing this high within the next couple of months, that's a pretty good probability, isn't it? The way it's been moving around, or come down, I think, what was I picking, the 50 some odd strike down here. So that's a pretty good probability. Either one of those could happen in my eyes, especially the way things have been moving. So those two strikes locations are pretty darn good. Now let's do one other thing here and go over the Analyze tab just to take a look at it, analyze this trade. So you can see that there's your break evens, the put strike on the downside, the put strike, which is here, minus that 1275, and the call strike to the upside. So at expiration, you can see I do need something to happen. But one thing to note, watch this purple line. If I just had the underlying stay steady here, and I make volatility expand, because I know I'm buying it really cheap. Look at that purple line. This is saying the underlying hasn't changed, but my profitability is starting to increase right away. That's a good thing. That's just with volatility expanding, me taking advantage of really cheap premium or really low volatility. All right. So that will help me. All right. So when I go back to all of this stuff, I was looking at, I already forgot the strikes. I think it was I'm looking at the 252s, taking 252 and I think it was 295, something like that, right? I write all this stuff down, and if I hit my strike, I'm getting out for a winner. And I can almost assure you, you go up there and hit that strike, another way to look at it is my premium increases by 50%. I'm getting out. So on that one, I was looking at a $12 premium. If my premiums go up to $18, I'm out. All right. So you can look at it that way. If my premium increases by 50%, I'm out of this trade. Or it goes up and hits those strikes, I'm out. All right. However you do it, write it down, stay consistent. All right. I usually am looking at it to go up there and hit those strikes. If it happens really quickly in the next couple of days, and I see that volatility start to expand ahead of it hitting my strikes, well, I might get out there also at taking advantage of that volatility expanding really quick, because I don't want to. I want to get in and out of these trades quickly. I want to swing for singles, doubles, and triples. Now on a loss, you could say I'm getting out. I'm out for a decrease of 50% of my premium. All right. So if my premiums go from $12 to $6, I'm out. I'm cutting my loss. I mean, it's just trading sideways, and you can even see volatility was probably starting to come out of it and stuff like that. Well, that might be a time to pull the ripcord on it. All right. Now I have a higher risk tolerance. I usually ride these things out a little bit longer than just getting out at 50% decrease. Okay. I usually put these on for especially like this specific strategy. I usually get out for a loss that's I'm riding into the sunset, which could be, I know that whatever I'm paying for that limited risk strategy is what I'm willing to lose, all right? And I'm looking to make a big move as a portfolio hedge or something like that, all right? Now, something else you can look at is along these lines. If you have a lower risk tolerance or you're very new to options trading, this is a decent guideline to follow. Also, is you could say, all right, if I'm in this trade for only 10 days and I get a 20% increase, and this is assuming a profit increase, right? If I get that 20% increase inside of 10 days, I'm looking to cut the ripcord, pull the ripcord. If I'm inside, look at this as less than 10 days, right? If I'm in less than 10 days, less than 15 days, I'm at a 30% profit. I'm getting out, all right? Less than 25 days at a 50% profit, which is where I look to get out of this. If I can get a 50% increase in my premiums, I'm looking to get out, all right? So that's another good guideline that I've kind of come up with. I used to use this true to form for several years. Now I'm kind of, I realize that I like to have my risk tolerance, or my risk tolerance is a little bit higher. So I usually go for my strike location. But one thing I do is write all of this stuff down so that I stay mechanical, because if you have too many different rules where it's, all right, well, 25 days or whatever, it's 50% or, a 50% increase, or it hits the strike, all of those things. Write down what you think you believe is going to happen at the beginning of this trade, because it will keep you mechanical. If you have too many outs, I'm just giving you different options to pick from. If you have too many of those going on in your head, you're going to have a tendency to say, all right, well, the market moved, volatility expanded, I saw that 50% in premium, but now I want it to go to the strike location. You've changed your methodology in that strategy, okay? And that's never a good thing, all right? It's never a good thing to change midstream. So bottom line is, write these things down so that you are holding yourself accountable for your actions, right? If nobody's looking over your shoulder, you're going to have a tendency to finagle, and that's really where we have pitfalls that come back to bite us, right? So stay away from that. But pick one of them, stick with it for a while, and then, if you want to increase your risk parameters, like this would be the lower risk tolerant person, doesn't want to take a lot of risk, or a newer trader. If you're thinking that it's got to go up and hit your strike, that's probably a higher risk tolerant person. When you're getting the next step out after this one would be saying, okay, 50% increase is where I'm looking to get out. Would be like a yellow or midline person with a risk tolerance. This is going to be somebody with lower risk tolerance. Hitting my strike is going to be a higher risk tolerant person. Okay? Everybody following me so far? I'm either doing a really good job of explaining this, you guys or I'm boring and you guys are falling asleep, or I don't know what the other thing would be. All right, so anyway, without any more questions, here is your offer for today, earnings with options. Some of you guys might be like, hey, we're already out of options earnings already. Well, a lot of these are setting ourselves up for the next options round. So literally, it's like the perfect time. If you have an underlying, you want to set yourself up for another, you have a strategy that you want to do for a longer term. Maybe it's Apple. You think they're going to knock it out of the park in the next earnings, or heading into that, you're going to hear a lot of good sales on the new iPhone. I think, what is it, 12 or whatever? Well, setting yourselves up for the next options, the next earnings. We have strategies for that will help you take advantage of those types of assumptions around those earnings. There's still earnings out there to be had where we have strategies for those. Those are real quick hits, in and out. A little bit different guidelines for those earnings trade specific. You know, we're not going to be going way out in time necessarily for an earnings that's tomorrow. And I go into the details of where our strike locations are for those specific events. All right. So a little bit different than just our regular, you know, I've got an assumption in this for the next couple of weeks. So earnings specific, a little bit different. So please take advantage of that. Yes, I am throwing that out in the chat window right now. Let me know if you saw it over there. You can click on that link. That's a hot link. If you're watching it on tape delay, you guys are going to have to go back and punch this into your URL. So, hit the hot link or type that into your URL. Finally, I want to thank you guys all. Thank you, Alexander. Appreciate the kind words. Take it easy, buddy. Here's another link for that. If you have any questions, comments, or ideas for future webinars, please reach out to us at 310-598-6677 or trading@protraderstrategies.com. If you've liked what I've done, if this is starting to resonate with you, please take advantage of that. Also, next round, if you liked it, one of the nicest things you can do is invite a friend. Tell somebody, hey, go check out these webinars. They really are clicking with me. They might click with you. The only way to increase the yield in your portfolio, you guys, is the trade with options. If you just have a long-only portfolio, you should be playing around with some options to increase that overall yield. All right, last thing is the disclaimer. Please take a moment to go over this. We are an educational company. I'm not trying to solicit you guys to jump off the cliff with me in DIA or in Johnson & Johnson. I want you guys to make your own decision. That I want to emphasize. I want you guys to learn how to trade. And this will help you learn, or these options courses will help you learn how to trade and make your own decisions. I'm not a believer in giving trade recommendations. I don't believe in it. I think that we can all come up with our own decisions. But what I do believe in wholeheartedly is that if you want to increase your probabilities of success trading, especially even you want to increase your probabilities of success, use options. If you want to even turn the tables greater in your favor, follow this course. Make sure you follow my rules, my guidelines. You know, those are specifically set up to streamline your process. Make sure that you guys are thinking correctly, and hopefully that works, because believe me, I've worked on the floor and we didn't always have the opportunities that we have now in the trading. So I've tried to help you avoid some of those pitfalls I've fallen into. All right. So without further ado, that's all I got for you. If you can't take that, take it easy. Really clear, easy to understand. Thanks. Thank you, Mace. I appreciate the kind words. Appreciate it. Thanks, Sami.